Last week, something monumental happened. A day that marked the end of one type of economy and the start of another. It is something that is slowly changing the world economy, but behind closed doors. And it's something that large financial institutions don't want you to know about. So what is this thing? Well, let's step back to the 1980s. Big hair, cocaine, Michael Douglas yelling, "Greed is good." Back then, institutions trading huge amounts of stock needed a way to do it quietly. So, in 1986, a company called Instinet created something called the first dark pool of money. So just to quickly explain what really dark pool money is, it goes something like this. Dark pools are private, hidden stock markets where big players, banks, hedge funds, billionaires, and many others in the elite club trade huge amounts of stock without the public ever seeing it. It's like Wall Street's VIP section where the real deals actually happen and us regular people are stuck outside like losers at the club. Not that that's ever happened to me. It was like an underground poker game but for stocks. No lights, no cameras, just trades happening in total secrecy. At first, it was a niche thing. Banks and hedge funds used it to swap stocks like they were exchanging bags of cash in a parking garage. But then the government stepped in. In 1998, the U.S. Securities and Exchange Commission, or the SEC, introduced Regulation ATS, which is Alternative Trading Systems. This was supposed to give investors more options to trade outside of traditional exchanges. But as always, Wall Street found a way to turn this into a money-printing loophole. By the early 2000s, more dark pools of secret trades popped up, and big banks realized, wait, if we control dark pools, we can control who gets the best prices without anyone knowing. Dark pools were supposed to be a way for big investors to trade large amounts of stock without screwing up prices. Because if a hedge fund needs 5 million shares of, Apple on the New York Stock Exchange or the NASDAQ, the second people see that order, panic sets in and prices tank, and well, that's bad for the seller. So they said, let's just do these big trades, in secret. And that's how dark pools were born. No price impact, no public record, just billionaire handshakes behind a velvet curtain. But in 2005 comes Regulation NMS, which stands for National Market System, which was a well-meaning but completely naive SEC rule. It was supposed to make sure investors got the best price available no matter where a trade happened. And it sounds great, right? Well, it wasn't. Instead, banks realized they don't have to use public exchanges at all. They can match trades in secret as long as the price is close to the public one, and they can do all of this in dark pools away from watchful eyes. Now, between 2005 and 2012, dark pool trading exploded from 3% to 40% of all stock trades, and by 2025, in fact, by last week, the monumental day, the majority of all trades is now dark pool. But now, as of 2025, in fact, as of last week, more than half of all trades on the stock market are dark pool money trades, meaning that half of stock trading is now invisible to millions of people that trade on the stock market. It's not happening on the New York Stock Exchange, not the NASDAQ. It's happening in private markets owned by Wall Street itself. So now that the billionaires and the dark pools officially run the majority of the investing world, let's break down what this actually means for us peasants. When you check a stock price, you think, oh, this is what people are paying for it. Nope, that's just what the little guys are paying for it. The real price now is set in dark pools where billionaires and hedge funds make their deals in secret. Imagine if Amazon had a second private website where only rich people got special discounts and you weren't allowed to see it. That's what dark pools are doing for stocks. So if now more than half of all trades are off exchange, how do you know if the price you're paying for it is fair? Well, you don't, and it probably isn't fair. Because big investors get first dibs on price movements. In fact, your trades that you might make on something like Robinhood, they go through market makers like Citadel who profit off of your trade. You never directly invest into the stock market ever, even if you make trades through your bank. There's always some third party that's in the way. And so if all of this sounds bad to you, well, it kind of is and has been. In 2014, Barclays ran a dark pool called LX, which they marketed as a safe investment for high-frequency traders. Except, oops, they were secretly letting HFTs feast on everyone else's trades. When New York's Attorney General found out, Barclays got hit with $70 million in fines, but, fun fact, they made way more money than that from the scheme. So naturally, they just kept doing it. A little bit before that, on May 6, 2010, the Dow Jones plummeted nearly 1,000 points in just a few minutes. And one of the best examples of dark pool trading actually came during the GameStop frenzy of 2021, where actually 80% of GME or GameStop trades were happening off exchange in dark pools. Retail investors were wondering, why isn't the stock moving higher when everyone is buying it? Well, that was because most of the trades were being internalized in dark pools and market makers like Citadel. They weren't letting the orders move the price on public exchanges. But these are just a few examples of how dark pools are directly affecting some of the trades that you make. But now I want to ponder, how bad could this all get? I mean, dark pools were just a small fraction of the stock market just 40 years ago, and now they are the majority of trades. So let's set up the worst case scenario. What if dark pools keep growing until they completely take over the market? We're already at 50% of trades happening in secret, and some Wall Street insiders think by 2030 it could be 80%. If that happens, stock exchanges will become just the place where small investors trade, while big money operates in its own private system. The stock price you see will just be completely fabricated. The trades you place are priced in after all of the billionaires and all of the financial institutions already have made their decisions. And all of a sudden, it's not just average everyday investors that are left out of the market, it's millionaires or even multi-millionaires. They're getting left out now too in this scenario. And this is not just conspiracy talk because it's already happening. So anyways, in this first scenario where 80% of trading is dark, the stock market just becomes a theme park for retail investors and Wall Street bets. The actual market and the real money, it moves in private and we'll never see it. But another potential path and scenario is the liquidity death spiral. So what happens when so much trading happens in dark pools that the public markets can't even set real prices anymore? So right now, dark pools piggyback off of stock exchanges. They match trades based on public prices. But if too much trading moves to the dark side, well, then public stock prices become unreliable. So in this scenario, large, gigantic price swings become pretty realistic because there aren't those big public orders to stabilize prices. Instead of a stock having a down day of 1 or 2%, all of a sudden, the average down or up day could be 5 or 10% or more. In this scenario, market crashes would also be worse. Flash crashes would happen all of the time, just like they did in 2010 for one day, except they would happen many times per year. All of a sudden, the high-frequency traders and the algorithm traders, well, they now have to deal with giant price fluctuations, and their algorithms, well, they might not do too well in this kind of scenario either. Meanwhile, a lot of those, mid-level $100 million institutions, well, they would struggle during this as well, and they could go under, and all of their money would go to the large financial institutions that would buy them out. But now another thing that could hopefully happen is, well, the SEC grows a spine. But this is pretty unlikely. You see, the SEC has been talking about dark pool money for years, but they haven't done anything. They could require big institutions to execute a certain amount of their trades publicly, preventing them from permanently hiding in dark pools. Europe already does this, by the way. The EU caps dark trading at 8% per stock. The US could do the same, but Wall Street lobbyists would fight it harder than a toddler fights at bedtime. So what should you take from all this? Well, when you see a stock price, it's probably fake now, and it's going to get more fake into the future. The large $100 billion or $1 trillion institutions, well, they get to make a lot more money now, so that's great. Good for them. They will make all of this money in private, we won't see any of it. If a large group of traders trade through apps now, as we know, it doesn't really matter. Big market makers control everything now. And the stock market is becoming more and more of a fake game where billionaires play in private and retail investors trade into a rigged system. But what do you think of all this? What do you think about dark pool money? Where do you see it going? And do you think that this is a major problem in the United States and in the world right now? Let me know in the comments down below. See ya.